Hi guys, ang napapunta po sa aming topic ay managing credit risk on the balance sheet and managing liquidity risk on the balance sheet. I-discuss ko po muna ay under po ng managing credit risk on a balance sheet. By that, alamin po muna natin kung ano po ba ibig sabihin muna ng credit risk. Credit risk is the probability of loss due to a borrower's failure to make payments on any type of debt. Also, most simply defined as the potential that a bank borrower or counterpart will fail to meet its obligation. Parang sinasabi lang po dito na yung si borrower pag nangutang sa bangko, parang yung obligation niya na magbayad ay parang hindi niya na nagagawa, na hindi na nababayadan yung bangko. So, ibig sabihin, dun sa bank, parang meron na silang credit risk dahil yung pinakutang nila ay hindi na nakapagbayad sa kanila. Ito is credit risk management. Credit risk management is a practice of mitigating losses by understanding the adequacy of a bank's capital and loan loss reserves at any given time. Also, the goal is to maximize a bank's risk-adjusted rate of return by maintaining credit risk exposure within acceptable parameters. Dito naman po sa credit risk management, parang yung mga ano po dito sa bangko, parang mini-maintain or para mapagaan po yung mga losses na nawala po sa kanila gawa nga po nung borrowers na mga hindi po nakapagbayad, or parang dito po sa credit risk management, parang sila na po yung parang nagma-maximize kung magkano lang po ba dapat talaga ang pinakang credit or pautang po nung sa mga bank para hindi po sila malugi. Next is a credit quality problems. The credit quality of many financial institutions' lending and investment decisions has attracted a great deal of attention. Attention shifted to the problems relating to commercial real estate loans, to which banks, thrips, and insurance companies were all exposed, and a junk bonds. Junk bond is a bond rated as speculative or less than investment grade by bond rating agencies. Dito naman po, parang dun naman po sa credit quality problems mo ng ibang mga financial institution, parang ito daw po ay nag-ano ng worst case na kung saan pwede daw po mag-cause ng mga financial institution na maging insolvent. Kumbaga parang yung mga financial institution po ay yung iba po ay hindi na makakabayad. And then doon naman po sa junk bonds, parang in the word junk, so ibig sabihin parang yung mga bonds po na ano ay parang patapon na or parang basura or parang wala na pong masyadong halaga, kasi parang ito po ay nag-ano ng high risk na din po. And then parang kung sa iba po mga investment, ito po ay yung mga grade po, parang investment grade po ng mga sa investment ay parang matataas, pero pag sinabi pong junk bonds, parang napakababa na po nito. Parang kung i-grade po natin siya, parang pwede po siyang maging negative. Next naman po is credit analysis. Dito po ang madidiscuss po ay about real estate lending, consumer and small business lending, mid-market commercial and industrial lending, and last po ay large commercial and industrial lending. Ang i-discuss ko po ay about sa real estate lending. Pag sinabi pong real estate lending, parang it refers to a mortgage po. Tapos it commonly used by a home buyers to finance a real estate. Dito po parang ang example po nito ay yung sa bayan po, yung Amaya Escape po ba yun, na kung saan doon po nag-ano ng mga real estate, ng mga bahay at lupa, may mga ahente po doon. And then kunyari po ako po ay borrowers, or kung ako po yung nag-ano nung sa loan na yun, parang magsasign po muna ako ng legal document kung ito po ay na-approve na, and then parang dun po sa parang willing po ako na magbayad no sa loan within a period of time na may kasamang interest. And dito po sa is yung sa mortgage or sa real estate lending po is generally one of the least expensive ways to finance a home, but it can also be one of the more intimidating processes of a beginner homebuyer undertakes. Ang sinasabi lang po dito, parang ito po sa pag-ano po ng real estate lending, parang napakadali lang po siya, parang hindi po siya masyadong magastos kasi gawang may kausap ka na nga po. Pero sinasabi din po dito na yung sa real estate lending po ay parang madaming prosesong ginagawa bago ka makaano po nung sa kinuha mong loan na bahay at lupa. And then there are two considerations to approve a mortgage loan application. Una na po dito, parang yung sinabi ko nga po, the application's ability and willingness to make timely interest and principal repayments. Yung sinabi ko nga po katulad kanina na yung borrower po parang willing po siya na magbayad ng loan pero na may kasamang interest sa parang period of time. At ang pangalawa naman po ay yung the value of the borrower's collateral. Parang sinasabi dito, parang kung ikaw ay nag-loan tapos parang may ganito kang collateral, parang papayagan ka nilang mag-loan dahil kung wala ka man maibayad, parang yun na lang ang magiging kapalit. Two ratios useful in determining a customer's ability to maintain mortgage payment. First is the GDS or gross debt service, and the second is a TDS or total debt service. The formula for the gross debt service is a GDS is equal to annual mortgage payments plus property taxes over the annual gross income. And the formula for the TDS is equals to annual total debt payments over annual gross income. For the calculation of GDS and TDS naman po, dito po, ang FI or financial institutions po, parang meron po silang sineset na percentage para sa GDS at TDS para maging approved ka po sa iyong mortgage loan. For the customer 1 po, ang kanya pong gross annual income is 150,000. For the monthly mortgage payment po is a 3,000, and the annual property taxes is a 3,500, and for the monthly other debt payments is a 2,000. To compute a GDS for customer 1, 3,000 multiplied by 12 because of 12 months plus 3,500 over 150,000. The percentage is 26.33%, and for computation for TDS, 3,000 multiplied by 12 months plus 3,500 plus 2,000 and multiply it for 12 months or 150,000 equals to 42.33%. Meron din man po tayong customer 2 na kung saan meron po siyang gross annual income na 60,000, monthly mortgage payment for 500, annual property taxes for 1,500, and monthly other debt payments for 2,000. To compute ng kanya pong GDS ay 500 multiplied by 12 plus 1,500 divide 60,000 is equals to 12.50%. Yun po ang kanyang GDS. And sa TDS naman po sa customer 2, 500 times 12 plus 1,500 plus 200 times 12 din po kasi 12 months over 60,000 is equals to 16.50%. Dito po parang dun po sa customer 1, kahit po na mataas ang kanyang gross income, hindi niya naman po na-meet yung percentage na hinihingi ng mga financial institution na kung saan ang hinihingi po ay 25% at saka 40%, ay ang kanya pong percentage po na nakuha for the GDS is 26.33% and for the TTS is 42.33%. Kasi po gawa ng meron po siyang high mortgage tax and other debt payments na kung saan ang laki po. And for the customer 2, kahit meron lang po siyang medyo mababa na gross annual income, tas kung saan merong konting bayarin, naabot niya naman po yung percentage na hinihingi ng financial institution dahil ang kanila pong percentage for the GDS is a 12.50% at saka ang kanya pong percentage for TDS is a 16.50%. Next naman po is a credit scoring system. Credit scoring system is a mathematical model that used to observe characteristic of a loan applicant to calculate a score that represent the applications or applicant's probability of default. Dito po parang may sinusunod po na kung saan parang kung dun po sa pag-i-score nila sa iyo, kung papayagan ka ba or ma-approve ka po baga sa pag-loan or hindi. Liban po dun sa credit score system, ang ibang financial institutions po ay parang may iba pang ginagamit na pag-i-score para po dun sa mga applicant. Ito na nga po yung FICO or FICO. Ang ibig po sabihin ng FICO ay Fair is a corporation na kung saan ito po ay dinevelop ni na Bill Fair and Earl Isaac na kung saan meron po silang 10 factors na ginawa to determine a loan applicant's score by using a FICO. First is a major derogatory items on a credit report such as a bankruptcy, foreclosures, and slow pay. Dito po parang tinitingnan po nila kung yung loan application po ba ay na-bankrupt na dati or kaya po sa pagbabayad po ay parang napakatagal, kunyari due date na pinapatagal parang mga ilang araw or ilang buwan. Ang next naman po is a time at present job. Dito po tinitingnan kung ikaw po ba ay regular or hindi sa iyong trabaho, kasi parang sinusukat din dito kung may kakayahan ka nga din po talaga magbayad. Next naman po, the fourth one is a time at present address. Tinatanong din po dito parang ilang o gaano katagal ka na naninirahan sa iyong tirahan ngayon, kasi malay po natin na bagong lipat ka lang or napakatagal mo na doon sa ano. Panglima naman po is a ratio of balances to available credit lines. Parang dito po, titingnan din kung yung ratio na po yun ay parang sakto. Kunyari po, ang ratio mo ay sa debit side ay nasa 5. Or pag inanaman po sa ratio ng credit lines parang 1. So, ibig sabihin parang may kakayahan, tinitingnan ko may kakayahan ka talaga magbayad. Number 6 is a currently a homeowner. Tatanong lang po dito kung yes or no. Next is a 7, number of recent inquiries, kung saan parang titingnan po dito kung nakailang inquiry ka na. Malay kasi nila na madami ka palang in-inquiran, hindi lang sa kanilang baka sabihin natin 3 o parang mahihirapan ka kasing magbayad nun kung madami kang naanuhan or na inquiran, tapos dun sa 3 yon nakapasok ka, or sabihin natin approve ka. Pang-walo ay ang age, na kung saan tinitingnan din po itong age kasi gawa ng sabihin natin na baka ikaw mas bata or mas matanda, kasi titingnan ito gawa ng pag ikaw mas bata parang napakatagal or hindi mo agad-agad mababayaran yung kanilang loan. So, ibig sabihin parang malulubog or mas lalaki ang iyong babayaran. Pag ikaw naman yung parang matanda na or sabihin natin ay parang pa 50 plus or ganun, parang titingnan din kasi gawa ng baka hindi mo na siya mabayaran kasi sa sobrang tanda mo na. Next naman po is a number of credit lines on a application's credit report. Parang dito po titingnan kung ikaw ba ay madaming pinagkakautangan sa iba or kaya naman po ay mga ano sa ibang pinagkukunan or meron ka pang mga binabayaran hanggang ngayon. At ang panghuli naman po ay years the applicant has had a credit in a credit bureau database, na parang dito po tinitingnan kung bago ka umutang, parang matagal na bago ka uli umutang. So, ibig sabihin parang may mga palugit na 1 taon or mga 2 taon bago ka uli makautang.
So, good morning. I am Regeline Castillo and I am here to report about credit analysis and consumer or individual and small business lending. The techniques used for mortgage loan credit analysis are very similar to those applied individual and small business loan. Individual consumer loans are scored like mortgages, often without the borrower ever meeting the loan officer. So, paano nga ba ina-analyze sa pagpapautang sa individual? So, sabi dito, mas complicated daw magpautang sa individual kasi tinitingnan ng debtor yung mismong individual na uutang kaysa dun sa mismong business. Tinitingnan dito kung meron ka bang kakayahan na magbayad as an individual. Mid-market, commercial, and industrial lending. Credit analysis of mid-market corporate customers differs from that of small business because while still assessing the characters of the firm's management, its main focus is on business itself. So, dito naman, iba siya dun sa small business kasi dito na sa mid-market, commercial, or industrial lending is mas tinitingnan kung ano yung business mo. Kaya dito, sa pag-a-analyze ng mga debtors sa creditor dito sa mid-market is papasok na yung 5 C's of credits. So, ano nga ba yung 5 C's of credits? 5 C's of credits consists of customer's character, collateral, conditions, and capital. So, what is customer characters? Customer's characters is, so although it is called characters, it is refers to credit history of borrowers. It is reputation of a borrowers if he or she is paying his credit to the lenders. It is also a track records of borrowers if he is repaying debt, and those records will appear to the borrower's credit reports. So, ito yung pagbabasihan ng mga lenders if yung borrowers is maganda yung reputation niya para makakuha ng pera na inuutang. So, sabi din dito na yung mga lenders is may minimit sila na minimum credit score para ma-approve yung isang borrowers. Minimum credit score requirements will vary from lender to lender and from one loan product to the next. The general rules of a lenders is the higher the score credits is the higher the likelihood of receiving the approval of na pwede siyang pautangin ng lender. Next C is capacity. So, yung capacity lang is mine-measure ng lenders kung ano yung kakayahan ng isang borrowers na makapagbayad dun sa uutangin niya. So, yung lenders, dapat alam niya yung debt equity ratio ng borrowers. So, what is debt to equity ratio? Debt equity ratio is equal to borrower's total debt payments divided by total gross income of a borrower. So, the lower the DTI daw is the lower the DTI is mas mataas yung chance mo na pautangin ka ng lenders kasi yun doon nakabase yung gross, yung mga debts mo. Ibig sabihin, nakakover nung gross income mo yung mga debts. Kaya, mataas yung capacity mo na makapagbayad sa mga utang. So, next is capital. So, yung capital is tinatawag siya na level of seriousness. So, bakit? Kasi daw, yung makukuha mong pera, if ever na mag-grant ka, is dapat meron ka ng paglalagyan. Sabi dito, lenders also consider any capital the borrower puts forward of potential investment. So yun, kaya siya tinawag na level of seriousness. Dapat yung makukuha mo lang, hindi mo lang basta gagastahin sa kung saan-saan. So next C is collateral. So it gives the borrower to secure loans. So makakatulong para it gives the lenders assurance kung para pag hindi nakapagbayad in cash yung mga borrowers, so meron silang assurance na pwedeng kunin. For example, yung katulad ng mga nakikita natin na pag hindi nakakabayad sa, kunyari, sa car loans, pwedeng i-pull out yung mga gamit sa bahay, kunyari yung mga TVs, ganyan. So, yung mga loans naman na inisyo na may collateral is mas mababa yung interest kasi nga, once na hindi makapagbayad si borrowers, ang kukunin na lang ng mga lenders is yung mga naka-collateral dun sa ginawa niyong agreement. Last C is condition. Ito, ina-assist ito ng the condition of loan such as interest rate and amount of principal influence the lender's desire to finance the borrower. Condition can refer to how a borrower intends to use the money. Consider a borrower who applies for a car loan or a home improvement loan. A lender may be more likely to approve those loans because of their specific purposes. So, dito naman sa condition, sinisecure lang ng mga lenders yung mga interest rates kung nababago ba dahil nga minsan pag gumagalaw yung economy, so nababago din yung mga interest rates. Kaya tinitingnan ng lenders chinecheck din ng lenders yung conditions. Is ratio analysis. So, yung ratio analysis, meron siyang 5. The liquidity ratio, asset management ratio, profitability ratio, debt insolvency ratio, and quotient with ratio analysis. So, yung liquidity ratio is equal to current asset divided current liabilities. Which means, pag mataas yung times mo pag mas mataas yung times mo, ibig sabihin, mas maganda. Kasi, pinapakita lang doon na ganun mo pwedeng ma-cover up yung liabilities mo. Kunyari, for example, meron kang 3,697 current assets and divided by 2,676 current liabilities is equal to 1.38 times. Ibig sabihin, ganun mo pwedeng ma-cover yung liabilities mo. 1.38 times mo pwedeng ma-cover ng current asset mo yung current liabilities mo. Next is asset management ratio. So, doon sa asset management ratio, kinukompute yung number of days, sales and receivables, number of days in inventory, sales to working capital, sales to fixed asset. So, naniniwala ako na alam na po natin ito lahat kasi napag-aralan naman natin kung paano mag-compute nun sa FM last time. The asset management ratio gives the account officers clues as how well the applicant uses its asset relative to its past performance and the performance of the industries. Next is debt and solvency ratios. So, dito sa debt and solvency ratios, measure yung debt to equity ratios, debt to asset ratio, times in interest earned ratio, cash flow to debt ratio. So, feeling ko alam na rin naman po natin yan. So, dito lang daw sa debt and solvency ratio, it gives the account manager an idea of the extent to which the applicant finances its asset with debt versus equity. Especially, the lower the debt to asset ratio, the less debt and more equity and the applicant uses to finance its assets. Profitability ratios include measure in gross margin, operating profit margin, return on assets, return on equity, and dividend payout. So next is quotients with ratio analysis. So yung quotient with ratio analysis, ibig sabihin binibigyan lang tayo ng warning na yung mga lenders hindi lagi dapat nakadepende sa ratio analysis kasi yung ratio analysis is meron ding limitation. Katulad nung kung yung iba ay kung yung iba ang measure na ginagamit sa kanilang depreciation is straight line method, kasi yung iba naman is accelerated cost recovery method. Ibig sabihin, mas madaling nakare-recover pag ang ginamit na method is yung accelerated cost recovery method. Common size, analysis, and growth rates. So, doon sa mga ratio na nabanggit kanina, meron din tinatawag na common size, analysis, and growth rates. An analyst can compute sets of ratios by dividing all income statement amounts by total sales revenue and all balance sheet amounts by total assets. This calculation yields common size financial statement that can be used to identify changes in corporate performance. Year-to-year growth rates also give useful ratios for identifying trends. Common size financial statement may provide quantitative clues as to the direction in which the firm is moving and as well as the direction of that analysis should take. So, the last one is following approval. Hindi natatapos dun sa mga agreements kung pwede ka bang bigyan ng lenders, kung pwede kang bigyan ng lenders. So, meron ding mga kailangan na following approval. As in this case for the mortgage loans, before allowing the drawdown, release of the funds up to the borrower, of a mid-market credit, the account officer must make sure that condition precedent have been cleared. Yung mga condition precedent is nakalagay siya sa credit agreements. So, dapat ma-fulfill daw yun bago releasean ng isang borrowers ng lenders doon sa kanyang inuutang. Maring sa credit analysis ng mid-market, commercial, and industrial lending ang cash flow analysis at ratio analysis. So, cash flow analysis is dito lang naman minemeasure lang naman yung inflow at outflow ng cash mo sa business. So, yung cash flow analysis, meron siyang tatlo. May under siya na 3. Cash flow from operating, cash flow from investing, and cash flow from financing. Cash flow from operating are those cash flows, inflows and outflows that resulted indirectly from producing and selling the firm's product. These cash flows include net income and changes in working capital accounts other than cash and operations related to short-term debt. Cash flows from investing activities are cash flows associated with buying or selling of fixed or other long-term assets. These sections of the statement of cash flow shows cash inflows and outflows from long-term investing activities. Mostly significant, the firm's investment in fixed assets. Cash flows from financing activities are cash flows that result from debt and equity financing transactions. This includes raising cash by issuing short-term debt, issuing long-term debt, and issuing stocks, and using cash to pay dividends, to pay off debt, and using cash to buy back the stock. Next is ratio analysis. Ratio analysis has has 5 ratios. Liquidity ratios, management ratios, debt and solvency ratios, profitability ratios, cautions with ratio analysis.
So the next type of credit analysis is for large commercial and industrial lending. So it is said that an FI's bargaining strength is severely diminished when it deals with large credit-worthy corporate customers. Why? Because large corporations are able to issue debt and equity directly in the capital markets as well as to make private placements of securities. So aside from this, hindi lang sila nagme-maintain ng credit relationship sa isang FI kundi sa marami pang ibang FI. Tapos, ginagamit nila yung pera para makapag-issue sila ng sarili nilang commercial paper para mapondohan yung kakulangan sa kumpanya nila. And kung may excess man dun sa funds, pinabibili nila ito ng treasury bills, bankers' acceptances, and other companies' commercial paper. Moreover, large corporate clients are not seriously restricted by international borders but have operations and access to international capital markets and FIs in many parts of the world. So, sinasabi rin na yung large corporations daw is mabenta sa mga FI kasi although kung fees ang pag-uusapan, hindi naman ganun kalakihan yung percentage na nakukuha ng FI sa isang large corporation. Pero, kung sakita naman, bawing-bawi yung FI kahit sa isang large corporation pa lang. Kasi isang transaction pa lang sa isang large corporation, malaki na yung magiging kita ng isang FI. Lalo na kung hindi ito nalulugi. So, next is the large corporations frequently use loan commitments, performance guarantees, and term loans as do mid-market corporates. If the FI is contracting in spot and forward foreign exchange or swaps, or is engaging in other derivative activities with the corporate client sa counterparty, it must do so within the credit limits established by a regular credit review process. So, an additional complicating factor for FI is that large corporate accounts often consist of several related corporate entities under a common management. So, sinasabi lang dito na yung isang large corporation, meron pa siyang handle na subsidiary company. So, parang mahirap yun sa part ng FI kasi sa halip na isang corporation lang yung sinusuportahan mo, nauuwi sa maramihan pang company yung nasusuportahan kasi nga may subsidiary company yung corporation na inuto na inut na pinautang mo. Since large corporation nga yung papautangin, hindi na basta-bastang amount ng pera yung hinihingin dito. Mas malaking corporation, mas malaking credit risk para sa mga FI na nagpapautang ang naghihintay. So dito, pwedeng gumamit ang mga FI ng credit scoring models para ma-determine kung yung kumpanya ba na nangungutang is karapat-dapat na pautangan o hindi. So, meron dalawang uri ng credit scoring models. Una din na dito ay yung Advanced Z-score. So, itong model na to is developed para sa public traded manufacturing firm sa United States. So, nakikita nyo, itong model na to, ginagamitan siya ng formula which is Z is equals to 1.2 x sub 1 plus 1.4 x sub 2 plus 3.3 x sub 3 plus 0.6 x sub 4 plus 1.0 x sub 5, kung saan yung Z is the overall measure of the borrower's default risk classification. Meaning, itong Z na to is siya yung magde-determine or tutulong sa FI kung papautangin ba nila itong kumpanya ito o hindi. So, ito namang mga X subscription, it represents various financial ratios of the borrower, wherein yung X sub 1 is the working capital over total assets, X sub 2 is retained earnings over total assets, X sub 3 is earnings before interest and taxes or EBIT over total assets, X sub 4 is equals to market value of equity over book value of long-term debt, and lastly, X sub 5 is sales over total assets. So kapag nakuha na natin yung Z-score, doon na pwedeng makapag-decide yung FI. So kapag mataas yung value ng Z, i-consider siya as low risk, meaning mababa yung chance niya na hindi makapagbayad sa utang niya. Kapag naman mababa or negative yung value ng Z, yung company is high risk, meaning mataas yung chance niya na hindi siya makapagbayad dun sa halagang inutang niya. So, next model naman is the KMV Credit Monitor Model. So, dito sa model na ito, simple lang ang sinasabi niya. Kapag yung company na nangutang is nag-fail magbayad or wala nang kakayahang magbayad, pwede siyang mamili na hindi niya nababayaran yung natitira pa niyang utang, pero yung assets ng kumpanya niya is ibibigay niya dun sa FI na inutangan niya. So, kumbaga, yung asset ng kumpanya niya is ginawa niyang collateral para dun sa utang niya. So, kapag naman may kakayahan pang magbayad yung kumpanya, wala namang problema dun sa both parties. Connection dun sa last topic, dumako naman tayo sa calculating the return on a loan. So we have here two ways or methods commercial and industrial firms could use. The first one is the return on assets method or the ROA, which is the traditional method. The formula is already stated there, and it is read as return on assets per dollar lent is equals to 1 plus the direct fees or F plus the loan interest rate or BR plus N over 1 minus the reserve adjusted compensating balance requirement or the 1 minus B times 1 minus RR. To apply this formula, we have here an example problem. So the given is 12% for the BR and 2% for M. The loan origination fee or F is 1/8 or in decimal form 0.125%. The compensating balance requirements or B and reserve requirement charge RR are both at 10%. So in this problem, the ROA per dollar lent is equals to 15.52%, which is larger than the promised interest return of 14%. The second method to use is the new approach, the risk-adjusted return on a capital method, or RAROC. So the formula to use is RAROC equals to 1-year income on a loan over dollar value of our loan multiplied by the unexpected default rate, again multiplied by loss given default. So again, we have here an example problem on how to compute for the RAROC of a firm. The given is 100,000 times 0.003%, which is 300, and that represents the 1-year income on a loan over 100,000 times 4% times 8% is equals to 3,200. So 300 divided by 3,200 is equals to 9.375%. So a loan will be approved only if the borrower's RAROC will match or exceed the FI's return on equity capital. So in this case, if the FI's ROE is less than 9.375%, the loan will be granted. However, if the ROE is greater than 9.375%, the loan should be rejected because it needs higher loan fees.
So today, let's talk about managing liquidity risk in the balance sheet. So, let's define first what is liquidity. It is converting your assets into cash. Nangyayari to pag hindi mo na kayang mabayaran yung short-term debts mo, yung assets mo ililiquidate na or i-convert na natin sa cash. Ang liquidity risk, nag-occur din ito sa entity pag ang investor or entity is not unable to convert an assets into cash without giving up capital and income due to lack of buyers or an efficient market. And a liquidity risk, and it is arises for two reasons: the liability side reason and an asset side reason. And first, let's talk about the liability side reason. It occurs when liability holders such as depositors or policy holders demands for the cash for the financial claims immediately. So ang ginagawa ng financial institution, they borrow additional assets, or maybe they will liquidate their assets para dun sa demand cash nung liability holders. And another one is when there have a sell-off. A sell-off is a large volume of securities are being sold in a short period of time. Sa sell-off, nangyayari ay yung mga securities bumababa yung price. Ang tawag dito ay fire sale price, na mas mababa yung price kesa sa normal price market. So second cause of liquidity risk is the asset side liquidity risk. Asset side is a transfer of cash to some other assets. For example, is the loan commitment. For example, I am the bank and you are the depositor. So you deposit to me your money. So yung pera mo na di-deposit sa akin, I will use that for loans or pagpapautang sa iba. So yung interest na yon, of course, that is my income. So ibig sabihin, nagagamit ko yung dineposit mo or nagiging ako ng revenue dun sa money mo na dineposit sa akin. And then, to understand much better the connection between liquidity risk And insolvency risk, let's consider the table 1, the adjusting to deposit withdrawals using asset sales. So in table 1, we can see adjusting to a deposit withdrawal using asset sales in a million. We will see the before the withdrawals and after the withdrawals. And there has the cash as asset sides and liability or equity sides. We have a cash assets of 10 million, non-liquid assets of 90 million, a deposits of 90 million, and an equity of 10 million. So ibig sabihin meron tayo na 100 million galing dun sa mga depositors. So, for example, suppose that the depositor withdraw unexpectedly at 20 million, mababawasan yung deposit natin. As we can see on the table, mababawasan ng 20 million yung deposit side natin. In the side of the after the withdrawals, we have a 70 million of deposits. Then wala daw replacement na ginawa yung depositors or binigay. Wala natanggap yung bangko na replacement dun sa 20 million na dineposit no depositors. So, ang mangyayari to meet the deposit withdrawals, yung cash assets ay isesell ng bangko, yung 10 million. So, kaya meron na tayong, makikita natin sa cash assets, we have a 0 dun sa after withdrawals. Then, suppose that financial institution cannot borrow any more funds in the short-term money market, and because it cannot wait to get better prices for its assets in the future, ang ginawa ng financial institution ay sinell yung non-liquid assets into 15 cents on the dollar. So, the remaining 10 million in deposit withdrawals, the 10 million in the deposit withdrawals, binenta ng 20 million yung non-liquid assets. So, magka-come up tayo sa after withdrawals ng 70 million sa non-liquid assets. Then, to incur the loss of 10 million for the face value of those assets, yung the financial institution must write off the losses against its capital or equity fund. Since its capital was only 10 million, yung equity natin ay 10 million, before the deposit withdrawals, may kita natin, we have 10 million in the before withdrawals in our equity sides. The loss on the fire sale of assets is 10 million, leaves the financial institutions economically insolvent. Ibig sabihin, we have a 0 equity capital or net worth. Hindi na natin kaya magbayad ng utang. So next is the liquidity risk and depository institutions. So let's define what is core deposits. Core deposits is the money that the customers deposited on the bank. Yung dineposit ng customer dun sa bangko, yun yung ginagamit na fund para sa loan, or it is a long-term funding source of the bank. Then there is also a net deposit. Sa net deposit, pag mataas yung deposit mo kaysa sa withdrawals mo, magkakaroon ng positive outcomes. Kung naman mas mataas yung withdrawals mo kaysa sa deposits mo, magkakaroon ng negative. So as we can see in the table 2, the effect of net deposit drains on the balance sheets. So ano yung net deposit drains? Ibig sabihin kabaligtaran na dapat ang isang bangko or a bank, dapat mas madaming nagde-deposit or mas madami siyang customers. So as we can see in table 2, may kita to dun sa PowerPoint presentation as well as sa table 1 a while ago. In table 2, it is the effect of net deposit drains on the balance sheet. So what is a net deposit drains? Ito ay kabaligtaran na usually dapat yung isang bangko mas madami nagde-deposit Kasi mas madaming nagde-deposit, mas madaming funds for loans. Katulad ng sinabi ko kanina, yung pera ng mga depositors, ginagamit yun ng bangko para sa pagpapautang. At yung pinapautang nila, pinapatungan nila ng interest. At yung interest na yun yung nagiging income ng bangko. So, sa net deposit range, kabaliktaran naman, mas kumukonti yung nagde-deposit dun sa bangko. So, as we can see, in before the drains, we have a good balance sheet, cash assets of 10 million, non-liquid assets of 90 million. In liability sides, deposits, 70 million, borrowed funds, 10 millions, equity, 20 millions, with a total of 100 million. And after the drains, we can see that our cash assets became 5 million, and the non-liquid assets remain as 90 million. The deposits is 65 million. The borrowed funds and equity remain as 10 and 20 million. And bumaba siya ng 5 million, and we have a 95 million after the drain. It means that mas madaming nagde-deposit or mas kumukonti yung nagde-deposit sa bangko natin. And yun lang yung pinapakita dito sa table, which is not good for the bank.
Hi, my name is Kim Rosa Kala, and I'm going to discuss about the deposit drains and bank run liquidity risks. At the core of bank run liquidity risk is the fundamental and unique nature of the demand deposit contract. Specifically, demand deposit contracts are first come, first served contracts in the sense that a depositor's place in line determines the amount he or she will able to withdraw from a DI. Develops, the demand for net deposit withdrawals grows. The DI may initially meet this by decreasing its cash reserves, selling off liquid or readily marketable assets such as T-bills and T-bonds, and seeking to borrow in the money markets. As a bank run increases in intensity, more depositors join the withdrawal line, and a liquidity crisis develops. Specifically, if the DE finds it difficult, if not impossible, to borrow in the money market at virtually any price. Also, it has sold all its liquid assets, cash, bonds, as well as any saleable loans. The DI is likely to have left only relatively illiquid loans on the asset side of the balance sheet to meet depositor claims for cash. However, these loans can be sold or liquidated only at the very large discounts from face value. A DI needing to liquidate long-term assets at fire sales prices to meet continuing deposit drains faces the strong possibility that the proceeds from such asset sales will be insufficient to meet depositors' cash demands. The DI's liquidity problem then turns into a solvency problem, that is which the DI must close its doors. So, moving on, regulators have recognized the inherent instability of the banking system due to the all or nothing payoffs features of deposit contracts, and as a result, the regulatory mechanisms are in place to ease DI's liquidity problems to deter bank runs and panics. The two major liquidity risk insulation mechanisms are deposit insurance and discount windows. So let's talk first about the deposit insurance. Its primary intention was to deter DI runs and panics, and its secondary intention was to protect the smaller, less informed saver against the reduction of wealth that would occur if that person were less in line if DI were to fail. Under the current deposit insurance contract, the small, less informed depositor is defined by the $250,000 ceiling, while the others, at least larger, more informed depositors with more than $250,000 on deposits, are at risk if EDA fails. As a result, these large uninsured depositors should be sensitive to DI risk and seek to discipline more risky DIs by demanding higher interest rates on their deposits or withdrawing their deposits completely. Until recently, the manner in which DI failures have been resolved meant that both large and small depositors were often fully protected against losses. This was especially so where large banks got into trouble and were viewed as too big to fail. That is, they were too big to be liquidated by regulators either because of the draining effects of the resources of the insurance fund or for fear of contagious or systemic runs spreading to other major banks. Thus, although uninsured depositors tended to lose in thrift and small bank failures, in large bank failures, the failure resolution methods employed by regulators usually resulted in implicit 100% deposit insurance. As a result, for large banks in particular, neither small nor large depositors had sufficient incentives to impose market discipline on riskier banks. So let's talk about the second liquidity risk insulation mechanism, which is the discount window. So a second mechanism has been the central bank's provision of a lender of last resort facility through a discount window. Suppose that a DI has an unexpected deposit drain near the end of a reserve requirement period but cannot meet its reserve target. It can seek to borrow from the central DI's discount window facility to offset this liquidity drain. Alternatively, discount window loans can also meet short-term seasonal liquidity needs due to crop planting cycles. Normally, DIs make such loans by discounting short-term high-quality securities such as treasury bills and bankers' acceptance with the central banks. The interest rate at which such securities are discounted is called the discount rate and is set by the central bank. Now let's talk about life insurance companies. Life insurance companies hold cash reserves and other liquid assets in order to meet policy payments and cancellations or surrenders and other working capital needs that arise in the course of writing insurance. Least predictable among these is the early cancellation of an insurance policy, which results in the insurer having to pay the insured the surrender value of that policy, which means that surrender value is the amount that an insurance policyholder receives when cashing in a policy early. Concerns about the solvency of an insurer can result in a run in which new premium income dries up, and existing policyholders as a group seek to cancel their policies by cashing them in early. To meet exceptional demands for cash, a life insurer could be forced to liquidate other assets in its portfolio, such as commercial mortgage loans, and other securities, potentially for at fire sales price. Forced asset liquidations can push an insurer like ADA into solvency. How about the property casualty insurance companies? PNC or property casualty insurers sell policies that insure against certain contingencies impacting either real property or individuals. These contingencies are relatively short-term and unpredictable, unlike those covered by life insurers. With the help of mortality tables, claims on life insurance policies are generally predictable. PNC claims that, such as the estimated $66 billion in insurance losses associated with Hurricane Katrina in 2005, are virtually impossible to predict. Thus, PNC insurers have a greater need for liquidity than life insurers. As a result, PNC insurers tend to hold shorter-term, more liquid assets than do life insurers. Moving on to guarantee programs for life and property casualty insurance companies. Both life insurance and property casualty insurance companies are regulated at the state level. Unlike banks and neither life nor PNC's insurers have a federal guarantee fund. Beginning in the 1960s, most states began to sponsor state guarantee funds for firms selling insurance in that state. These state guarantee funds differ in a number of important ways from deposit insurances. First, although these programs are sponsored by state insurance regulators, they are actually run and administered by the private insurance companies themselves. Second, unlike the Depository Institution Insurance Fund, in which the FDIC established a permanent fund by requiring DIs to pay annual premiums to fund in excess of insurance fund payouts to resolve failures, no permanent guarantee fund exists for the insurance industry, with the sole exception of the PNC and life guarantee funds for the state of New York. This means that contributions are paid into the guarantee fund by surviving firms only after an insurance company has failed. Third, the size of the required contributions that surviving insurers make to protect policyholders in failed insurance companies differ widely from state to state. In those states that have no permanent guarantee fund, each surviving insurer is normally leveled a pro rata amount according to the size of its statewide premium income. This amount either helps pay off small policyholders after the assets of the failed insurer have been liquidated, or acts as a cash injection to make the acquisition of a failed insurer attractive. Thus, the private nature of insurance industry guarantee funds, their lack of a permanent reserves, and low caps of annual contributions mean that they provide less credible protection to claimants than do bank and thrift insurance funds. As a result, the incentives for insurance policy holders to engage in a run, should they perceive that an insurer has asset quality problems or insurance underwriting problems, is quite strong even in the presence of such guarantee funds. So the last one is investment funds. Investment funds such as mutual funds and hedge funds sell shares such as liabilities to investors and invest the proceeds in assets such as bonds, and equities. Open-end investment funds most stand ready to buy back issued shares from investors at their current market price or net asset value. An investment fund's willingness to provide instant quality to shareholders while it invests funds in equities, bonds, and other long-term instruments could expose it to liquidity problems similar to those faced by depository institutions when the number of withdrawals or in this case, mutual fund shares redeemed rises to abnormally high or unexpected levels. If the market value of the underlying assets falls and is expected to continue to fall, fund holders will want to liquidate their positions as fast as possible. However, the fundamental difference in the way that investment fund contracts are valued compared to the valuation of the deposit contract reduces the incentives for investment fund shareholders to engage in deposit-like runs. Specifically, if an investment fund were to be closed and liquidated, its asset would be distributed to fund shareholders equal rather than on the first come, first served basis employed under deposit and insurance policy contracts. In conclusion, liquidity risk is a common problem that VA managers face. Well-developed policies for holding liquid assets or having access to markets for purchase funds are normally adequate to meet liability withdrawals. Very large unexpected withdrawals, however, can cause asset liquidity problems to be compounded by incentives for liability claim holders to engage in runs at the first sign of a liquidity problems. The incentives for depositors and life insurance policy holders to engage in runs can push normally sound FIs into solvency.